We have a pop-up promo sale this weekend, Friday through Sunday. It is a 15% off Club, Edge, or Chase with promo code TAKE15. Sign up today at LaDucTrading.com. I was doing this as part of my live trading room notes, by the way, and then it was just getting way too long. So I decided to punch it out here in market thoughts and then divide and conquer and put the trade recaps under trading room notes. So just if you're kind of curious. But yes, I am thinking of fundamentals. So right now, I kind of lead with a data trek quote on fundamentals because earnings. Very, very much focused. All your CNBC and Bloomberg and the rest and all of that are very, very, very much focused on fundamentals. Okay, fine. And then there are the macro focused and the quant focused, and then lots of people in between, which are mostly retail and technical. And I'm trying to combine it with intermarket and sentiment, blah, 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 policy intervention. So for right now, this is very much the lead. I don't want to bury the lead, but S&P earnings are expected to grow 20% between Q2 and Q4 of 2025, which would be remarkable. Burst of short-term growth that rarely happens outside of an early cycle economy. So they're not bearish. I'm not, I don't want to discredit here. Their data trek is also fundamentally based. If anyone has ever subscribed to their research, it is absolutely consensus by which the rest of big money follows. No question about it. But it is a stretch. That's all I'm trying to kind of identify. So even that's my point is that expectations, 20% earnings growth into year end is a stretch. And we have a rising tide of macro risks. So it's not hard to imagine, at least for me, it's not hard for me to imagine that we're going to get some fundamental assessment re-ratings and earnings estimates get re-rated moving forward. But it is very, very funny that many hedge funds don't even follow this. They really don't. They're more macro focused. They're more quant and technical focused. And I jokingly talk about, hedge funds really are just focusing on really heavily levered Mag 7 equities, and then they're chasing anything that moves. And in particular, this is what happened with Friday, right? Massive put buying, crash puts for Friday. That's a lot of hedge funds jumping in. So even Craig talked about that, right? He has his longer duration stuff, but then he trades zero DTE. That is so not my game, I can't tell you. But long story short, that is definitely a method of many hedge fund managers. And they probably were like, oh my God, look at consumer confidence, right? Even then it becomes an issue where your fundamentals don't matter until they do. And then they clamor for crash protection. So one thing yesterday that I want to kind of highlight, we got that consumer confidence readout in the morning and it was awful. It wasn't like a soft revision. It wasn't like a soft print. It plunged under 100 to 98.3 from last month's 105.3. So consumers are getting really nervous. This is the expectations, even though I'm not quite sure how they configure this, dropped even more. They plunged to 73 practically. So expectations are what we're dealing with, right, when it comes to sentiment. Sentiment is also kind of a pillar of all these silos: fundamental, macro, intermarket, quant, technical, sentiment. So the sentiment surveys are showing that they are very worried. Consumers are very worried about fewer jobs available 6 months out, right? So that's what this is about, is the sentiment of jobs, and prices are still rising. So that's why I wanted to kind of highlight this, because I think this is where we are at. Not only did 10-year plunge 11 basis points and it gapped down and below my stated 4.35. Remember, so I have that level and I keep pushing out. We're going to go hit that 4.35 level. We gapped below it. And why did that level matter is because that's exactly what I warned about on 12/12 when I posted that client post. Yields about to break higher. Remember the yield curve, and it was going to steepen and it was going to be boom, surprising. Anyway, we went all the way up and then we came all the way back down to exactly where we broke out, right? So now the 10-year, which is TNX, is sitting on 50-week and 10-month. So I'm still bearish yields, but it's one of those deals where it's the rate of change that will pick up a lot of deflation impulse. And so right now we've been in a deflation impulse, which I saw last week, right? Crashing oil, crashing yields, and that happened. I didn't see crashing gold. I mean, I saw crashing gold, but it didn't happen until yesterday. And it's following through today. So commodities are getting hit. So be careful on things like DBA, right? DBA is going to get hit. Silver is going to get hit. Gold's going to get hit, etc. So this is also sometimes what happens, Jeffrey explains, when you have peace. that, the commodities start to roll over with yields. So I'm looking at right now, big picture, I'm kind of thinking, all right, so I had this prediction, right? We're going to have this deflation impulse. And now what? And we already had de-risking in very, very short order in this high beta. So now what? Long story short, I think a return to the 10-year US yield below 3.9% on a monthly close will pull forward recession risk and target that 3.5%. So, and I also think obviously the White House wants to lower yields and dollar so that they can increase more tariffs. So I think this is a thing. I think this is the big picture kind of macro play. It's not in a straight line. You don't want that. And of course, my dollar level that I talk about is 105, but we'll get to that. Anyway, oil softening, the 10-year softening, the dollar softening, they're all related. And then that puts the bid in bonds and yen, but not gold anymore. I don't see the gold moving higher anymore. I know that's a change. So definitely that's a change. But for the most part, I think this March 14th government shutdown is going to influence this trade analysis. So I have a few weeks. Right now, let's just get through earnings. But so far, we really did have this deflation impulse come through. I didn't know it was going to be yields crashing on confidence, consumer confidence, on worries that the economy is maybe getting weaker. But that's exactly what happened yesterday. I just saw it last week. We were going to have a fall in, and I said, oil, yields, dollar keeps falling, equities pull down. All that happened until gold finally triggered yesterday, which tells me it's not done. So anyway, Besant would agree with all these consumer confidence survey respondents because he said yesterday, America's private sector is in a recession, which by the way is trouble because the government has already come out and said, we're going to shed all kinds of fat and labor from the US government. That's what Doge is doing. And at an alarming rate, some would say, not fast enough, others would say. And by the way, there's a lot of, by extension, civilian employment tied to government contracts, as I've talked about and written about, is 3 to 1. So for every one government firing, there are 3 civilians. That's how it works out. Anyway, the point is, Trump administration is saying private sector is going to grow. U.S. government's going to shrink. And the private sector is going to pick up this newly laid off, worker set. So the economy won't contract too much. Really? Besant just came out and said private sector's in a recession. So there's some color that I picked up, an RIA that I follow, an ETF, by the way. He's got a unique way of kind of parsing data, which I like. So I highlight those that I can that add some value to me and hopefully maybe to you. But he's like, wait a minute. Consumer confidence, it dropped the most in 3 years. Really, that's a lot. Lowest reading, since June. Inflation expectations have increased to 6%. Now remember, consumers are Main Street, not Wall Street. How Wall Street measures inflation is very different than how consumers measure it. Anyway, that is 3 times the Fed target. Very good reminder. Thank you, Eddie. And it comes at the same time that tariffs appear to go into effect. We have no idea. And he's right. We have no idea the timing, the intensity, the impact of this push on tariffs. But we do know that CEOs and CFOs are getting nervous. We know they're getting nervous. So here it is. We got falling retail sales. That was the latest print. We've got rising prices from inflation. You can see that, the consumer worry about jobs 6 months out, all the tariff triggered job loss announcements and warnings. It's no wonder consumers are worried. Now we come into jobless claims every Thursday and non-farm payrolls next Friday, and we might have reason for more worry, which is why those VIX calls for March of size have not been taken off the board. And then you add in what's happening in Japan with that bank run. You add in what's happening with the executive order from Trump, neither of which I talk about here because I've already talked about those things in detail. This is detail about the executive order on China, et cetera, et cetera. We'll talk about that on stocks. But the point is, right now, we have a situation where I think this is not going to be a straight line, but we're definitely going to have some more volatility coming in to the market, not less. Even if NVIDIA causes the market to move higher, either on its reported earnings or after its reporting earnings, and we bottom on Thursday, which is still my kind of baseline bet for a reflexive bounce. Big picture, we still have lots of divergences that bear watching. So this got us into that. That was Tuesday. And then things really started on Thursday. Friday, selling, biggest selling of the year. Monday, more selling after a pathetic excuse for a pre-morning gap up. Tuesday, more selling. Today we have a little relief. Thursday, we'll see. We definitely had my value growth rotation come back down into that 2.05, which I've been talking about. It's not a one and done. We have to now base here to move higher, or we're going to start to break below, right? And then we're going to kind of be in a very different market. But for right now, let's get through NVIDIA. Growth started dumping. High beta stocks started dumping. And that's a little bit more of what I talk about. We have had a 6% quote unquote re-rating in the Qs. Remember when I recommended short under 539? We had just hit, ironically, the high on Wednesday. Well, we tagged 509, in change yesterday morning, and I still see this being the trade. Oil and yields dump, yen and bond spike, pushing equities lower and triggering perhaps outsized volatility. This is still the macro collective trade. Even if we bounce, right now we've had a fabulous sector rotation where XLP, XLV, and TLT served as safety. Remember, in lieu of sector rotation, there will be volatility, and I still expect it in the next few weeks, triggered either before March 21st options expiration or because of the March 14th government shutdown. This is what I'm going to talk about in more detail in a future Market Thoughts.
Join Club today to engage with Samantha and her team of 10 experts. Scan this QR code or click the link in the description. Subscribe to LaDuc Trading YouTube channel for more live trading room recap videos and other content.